Welcome to this comprehensive exploration of the economics running a global logistics empire, a sector that literally moves the world we inhabit. Every single day, billions of packages traverse continents, cross oceans, and navigate international borders, fueling the interconnected global economy we all depend upon. But what truly lies beneath this colossal machinery? How do logistics companies manage to generate billions in revenue while simultaneously keeping operational costs under control? Today, we will uncover the economic secrets behind one of the most complex and genuinely fascinating industries of our time. Let us begin with the staggering numbers that define this industry. The global logistics market is valued at over $12 trillion annually, representing approximately 12 to 15% of worldwide gross domestic product. This is anything but coincidental. Logistics functions as the nervous system of global commerce and trade. Without it, international commerce would simply cease to exist as we know it. Enormous corporations like DHL, FedEx, UPS, and Amazon Logistics dominate this competitive space. Yet the sector remains remarkably fragmented, with thousands of local and regional operators who play crucial roles. The modern supply chain represents an intricate orchestra of extraordinary complexity. It begins with raw material suppliers, flows through manufacturing facilities, passes to distributors and regional warehouses, travels through sorting centers and hubs, and finally reaches the end consumer. Every single link in this chain carries associated costs, operational risks, and genuine opportunities for economic optimization. Logistics companies must orchestrate this entire ecosystem while maintaining strict financial efficiency. Let us discuss the business models that dominate this massive industry. Two primary approaches compete for dominance: the asset-based model and the asset-light model. In the asset-based approach, companies own their truck fleets, aircraft, cargo ships, and warehouse facilities outright. This requires enormous capital investments up front, yet offers complete operational control and potentially higher profit margins. FedEx and UPS constructed their global empires on this foundational model, investing tens of billions in physical infrastructure. The asset-light model, conversely, relies heavily on outsourcing and managing networks of strategic partners. This dramatically reduces initial capital requirements but substantially increases operational complexity. Many emerging logistics startups and e-commerce platforms employ this approach strategically. Amazon, for instance, began with an asset-light framework, outsourcing to third-party couriers, but has been gradually building its own proprietary logistics capabilities. Network effects prove absolutely crucial within this economic sector. The larger and more interconnected a logistics network becomes, the more exponentially efficient it operates. This creates significant barriers to entry for new competitors trying to break in. A company with truly global reach can distribute fixed costs across millions of shipments, dramatically reducing per-unit costs. This explains why dominant logistics companies continuously expand and consolidate their market positions. Economies of scale represent the bedrock foundation of logistics profitability and success. When a logistics company doubles its shipment volume, operational costs do not double proportionally. Fixed costs like warehouse facilities, information systems, and management overhead get distributed across significantly more units. This means the cost per individual shipment decreases substantially. This dynamic explains why logistics companies invest so aggressively in expanding total capacity. Now let us examine the operational costs that directly erode profit margins. Fuel represents one of the largest variable expenses. A single truck completing thousands of kilometers every day consumes enormous quantities of diesel fuel. When petroleum prices surge dramatically, profit margins compress very quickly. Many logistics companies build fuel adjustment clauses into contracts to protect against sudden volatility. Infrastructure costs are substantial fixed expenses. A single large automated warehouse facility costs hundreds of millions of dollars to construct. A truly global logistics network with multiple continental hubs requires billions in investment. These costs must be amortized over extended periods, meaning logistics companies must maintain high operational volumes to remain profitable. Technology has become increasingly essential. Real-time tracking systems, supply chain management software, automated sorting equipment, and artificial intelligence represent significant ongoing investment. However, these technology investments ultimately reduce operational costs through improved efficiency and better resource allocation. Personnel costs represent another major expense category. Truck drivers, warehouse workers, logistics managers, and administrative staff constitute a significant portion of total expenses. In most developed countries, wage pressures are increasing, which compresses margins further. This dynamic explains why logistics companies are investing heavily in automation technology. How do logistics companies actually generate revenue streams? Income generation is deliberately diversified. Standard shipments represent the volume foundation, but carry relatively modest margins. A typical standard shipment might generate gross margins of 10 to 20%. Express shipments and premium services command substantially higher margins, often reaching 30 to 50%, because customers willingly pay for speed and reliability. Reverse logistics, the process of managing returned merchandise, has become increasingly profitable with explosive e-commerce growth. Many logistics companies offer specialized reverse logistics services with attractive margins. Additionally, customized B2B solutions such as inventory management and contract logistics deliver much higher margins because they constitute genuine value-added services. Logistics companies actively diversify revenue generation. DHL, for example, offers supply chain consulting expertise. FedEx provides comprehensive e-commerce solutions and fulfillment services. These value-added activities boost overall margins substantially and develop deeper customer relationships. Let us now address the economic challenges the sector must navigate. Fuel price volatility represents a constant existential threat. A 10% petroleum price increase can reduce profit margins by several percentage points. Logistics companies attempt to hedge exposure through long-term contracts and price adjustment clauses, yet volatility remains a significant ongoing risk. International regulations add tremendous complexity and expense. Each country maintains distinct regulations regarding merchandise, transportation, required documentation, and applicable tariffs. Navigating this intricate regulatory maze demands extensive expertise and substantial resources. Logistics companies must invest significantly in regulatory compliance to operate legally across borders. Competition within the sector is intensely fierce and unrelenting. Margins are compressed, particularly in standard shipment segments. This has catalyzed major consolidation, with dominant companies acquiring smaller competitors. Yet competition remains severe, requiring logistics companies to innovate continuously to maintain profitability. Environmental sustainability has emerged as a critical economic challenge. Governments increasingly impose stricter emission regulations. Logistics companies must invest in cleaner vehicles, including expensive electric trucks that currently cost more upfront. However, long-term these investments could substantially reduce operational expenses and create new market opportunities. Looking forward, innovations are fundamentally transforming logistics economics. Automation is perhaps the most transformative force. Automated warehouses equipped with sophisticated robotics can process orders far faster with fewer errors than traditional operations. This reduces costs and improves service quality. Amazon has invested billions in warehouse automation, and competitors are following suit. Drones and autonomous vehicles promise to revolutionize last-mile delivery. Drones can deliver small packages in urban areas far faster and cheaper than traditional couriers. Autonomous vehicles could dramatically reduce transportation costs by eliminating driver expenses. However, these technologies remain in development stages and face significant regulatory hurdles. Artificial intelligence and predictive analytics are optimizing every logistics dimension. Machine learning algorithms forecast demand patterns, optimize delivery routes, predict vehicle failures, and improve resource allocation. These improvements translate into lower costs and superior service delivery. Sustainability represents not merely a challenge, but a genuine economic opportunity. Logistics companies investing in sustainable solutions can attract environmentally conscious customers and potentially receive government incentives. Moreover, sustainable approaches frequently reduce long-term operational expenses. In conclusion, global logistics economics represents a complex, dynamic, and profoundly fascinating sector. Success depends fundamentally on economies of scale, operational efficiency, and continuous technological innovation. Logistics companies that successfully manage costs, diversify revenue streams, and pursue innovation relentlessly will thrive and prosper. Those unable to maintain pace will fall behind. The future logistics landscape will be shaped by automation, sustainability commitments, and intelligent technologies. If this compelling sector fascinates you, continue following our content for even more detailed explorations. Subscribe to our channel, hit that notification bell, and comment below which aspect of logistics economics interests you most. Thank you for watching this video.